If we take the chart at face value, Warren Buffett's cash and treasury bills grew from roughly $63 billion in 2014 to almost $400 billion by early 2026. During essentially the same period, the S&P 500 rose from around 2,000 to over 7,000. That leads to us a simple question. If stocks have performed so well, why is arguably the world's most famous investor holding an amount of cash larger than the GDP of many countries? This chart compares the cumulative performance of Buffett's company, Berkshire Hathaway, and the S&P 500 from January 2000 through early 2026. Over this period, Berkshire Hathaway delivered approximately 1,200% total growth, significantly outperforming the broader U.S. stock market. By comparison, the S&P 500 generated roughly 400% cumulative growth during the same time frame. The difference shows Berkshire's remarkable long-term track record and its ability to compound shareholder capital at a rate well above the market average over multiple decades. Berkshire not only survived major market events such as the dot-com crash, the Great Financial Crisis, and the COVID-19 downturn, but consistently emerged stronger and continued to create value for shareholders. However, while the long-term picture clearly favors Berkshire Hathaway, the more recent years show quite the opposite trend. Since January 2025, the picture has changed noticeably. While Berkshire Hathaway maintained a strong relative position during the market turbulence of early 2025, its performance has largely stalled over the past year. Following the sharp market reaction to the tariff tantrum in April 2025, Berkshire briefly outperformed the S&P 500 as investors sought stability in defensive assets. That period reinforced the view that Berkshire could provide protection during times of uncertainty. However, the advantage proved temporary. As market sentiment recovered and risk appetite returned, Berkshire's stock lost momentum and failed to establish a sustained upward trend. By contrast, the S&P 500 has continued to demonstrate remarkable resilience. Despite two significant market scares, the tariff-driven sell-off in 2025 and the Hormuz crisis at the beginning of 2026, both of which produced sharp corrections, the broader market repeatedly recovered and pushed to new highs. The index remains in a powerful long-term uptrend, with each major decline ultimately followed by renewed buying pressure. Berkshire Hathaway, on the other hand, has spent much of the last year moving sideways. While it experienced periods of relative strength, particularly during episodes of market stress, the stock has not translated that defensive performance into meaningful long-term gains. The result is a growing divergence between a market that continues to advance aggressively and a company whose shares have largely been treading water. And all of this is happening right when the Buffett indicator, which is a reliable valuation indicator, is screaming overvaluation. The current value is 219%. That means the total stock market capitalization is more than twice the size of US GDP. The Buffett indicator is calculated by dividing the Wilshire 5000 by US GDP, and that ratio is now sitting at roughly the 219% level. For comparison, valuations today are around 2 standard deviations above the long-term trend line, putting them among the highest levels in history. We have also seen investors such as Michael Burry warn about the so-called AI bubble, which is vacuuming money from investors without getting a proper support by real economic growth. The important thing about Buffett's value investing mindset is this. Buffett is known for buying wonderful businesses at a fair price. And that is exactly the issue here. He is not necessarily predicting a crash, but rather avoiding businesses whose valuations do not justify their underlying economics. That is a very important distinction. To some investors, the Buffett indicator may appear to be predicting an economic collapse, but that is not necessarily the case. A meaningful market correction can happen even without a major economic breakdown. Those two scenarios may look similar on the surface, but they are fundamentally different. This is the most powerful factor in investing. Since 1900, the stock market has experienced periods of both extraordinary optimism and deep pessimism. Yet the longer-term pattern of returns has remained remarkably consistent. The orange line, representing the rolling 3-year average annual return of the S&P 500, fluctuates dramatically over time, reaching strongly positive levels during booms and falling into negative territory during major market downturns. Whether during the Great Depression, the stagflation era of the 1970s, the dot-com collapse, or the global financial crisis, returns have repeatedly deviated from their long-term average before eventually moving back toward it. This is a mean reversion, and it is one of the most important forces in financial markets. Historically, the average annual return has gravitated around roughly 10%, meaning that periods of unusually weak performance have often been followed by periods of above-average gains, while periods of exceptionally strong returns have frequently been followed by more modest outcomes. Mean reversion doesn't mean that markets move in a predictable cycle or that reversals occur immediately, but it shows that extreme conditions rarely persist indefinitely. Over long periods, returns converge back toward their historical average, creating the powerful self-correcting dynamic visible throughout the chart. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.